Hello, this is Luis Castillo, and I'm going to be talking about international trade financing. And the reason I decided to do this recording is because tomorrow at the Water Expo, I'm going to have a presentation. And because we're in Miami, possible we're going to have the audience that mostly is going to be in Spanish. So I have a presentation in Spanish, one in English. So this is the English one, just in case you want to listen over so you can understand how it works, the international and domestic trade financing. So here we go. Our normal situation is that we found ourselves in a business and we're growing, obviously, and we want to sell more. And we have an invoice at normal situation and we get paid. And what we like to do is grow our business, sell more, and stay ahead competing, right? That's what we were looking for. How do we do that? Most of the time, we do it by lowering the price, providing better quality, or a different service that separates us from the rest. But another way that we can do that is what I'm going to be this conversation about right now. And it's about improve your buyer's cash flow, providing credit. But by doing that is by giving credit to our buyers, we end up affecting our cash flow. We wanted to do it in a way that will not affect our cash flow. So we can buy more goods, so we can have inventories. So now let's put it on a new way, this way that I'm telling you, with the same invoice, the same cash that the buyer is gonna pay us. Now we don't have to receive the payment from the buyer. We can provide the buyer 60 days, 90 days, 120 days repayment, and we still get paid within 24 hours. So you're giving your buyer 60 days so they can pay you, but you do get paid right away in 24 hours. In addition to that, we're running the risk that what about if the buyer don't pay? If the buyer don't pay, then we have something else. We have asset protections. So if the buyer doesn't pay you, we can cover that payment up to 90%, and in other situation up to 95% of the invoice. That's with an insurance. And in addition to that, we can also pay your provider. That way we can do the whole flow of the business. So imagine we can pay your provider, let's say example, if it's $70 and your margin is 30%. So we're gonna pay your provider $70, and the provider is gonna free the goods so you can give it to your buyer, and you get paid in 24 hours. So that's basically what it is. And also we protect that if the buyer doesn't pay, the insurance will pay. So that's the whole cash flow. What type of credits we're talking about? We're talking short term, less than 1 year, medium term, which could be 3, 5, 7, 10 years, and long term, which is a large project, and that could be up to 15, 18 years. So what is my role or our role in our company? We're independent. We're not an employee of this company that you're going to see. Those are different carriers insurance, and we have the knowledge, and we can give you a different alternative. We educate you, we update you with information, and we assist you during the time of the growing of your business. The first contact in the policy, and this is a policy insurance, is us. We coverage about the coverage, about responsibility, about different rules that are involved. We're gonna try to avoid conflict of interest for your protection. I've been doing for a while, so I found one of the newspaper in Dominican Republic that I did a seminar in 2003. So that's as far as I found a third-party document that was showing that was doing a large seminar in Dominican Republic. So you can imagine now that what I'm talking about is about insurance. It's the same insurance like your car insurance, like your health insurance, like your home insurance. When we're talking about different carriers of insurance, there is one which is Exim Bank. Exim Bank is not a bank. Yeah, it's a bank, but it's a US government. But most of the time, it acts more as a carrier insurance. That's the government of the United States. And here you can see since 2002, I'm being involved with the Exim Bank. And 2021, when they start giving some recognition about how active you are with them, they give you like a plate every year. So we've been getting that plate every year because we're very active bringing clients and taking care of the clients that they send us. Because when you go to the U.S. government, like most of the U.S. government website, and if it has to do with trade, they're gonna send you to the Exim Bank. Most of the time, they send you to SBA, from SBA to the Exim Bank, from the Exim Bank, then they're gonna assign you to a registered broker, and that's where we are, and we'll take care of you. And now let's look at some of these companies that we know and we trust. Company like Delta, US Airways, Texaco, Kmart, all these companies, they have something in common. And they have something in common like the following that you recognize. Blockbuster, which doesn't exist, Lehman Brothers, and Enron. All these companies, they have been in bankruptcy at one moment during their lifetime. And those three at the bottom will disappear. The reason I'm showing this because even you believe that the company is so good, but here you have something called Chapter 11. And that Chapter 11 will protect the company. But if you don't fight to get paid back and you don't go into the court and spend money on attorney, you're never gonna get paid back. So when you have an insurance like the one I'm offering right now, you don't have to go through that, and the insurance will pay from 90 to 95% of the invoice. These type of insurance are mostly the two types. Let's call them private and public, government and non-government. Some of them, like CESE, is the government of Spain, that they have the insurance similar to Exim Bank. The UK, the Australian, the Swiss, they are different in every country. What they do, this company, they promote their export. And the private insurance is different. The private insurance is like your car insurance. They do domestic and international. So let's talk about export credit insurance, that's the one we're gonna be dealing right now. And then we're gonna move on to the government insurance, and then we're gonna go to the other ones. So it works very simple. Account receivable, I sell you one product, and then you pay me in 60 days, and I'm gonna have 3 buyers like that. That's my AR, my account receivable. That account receivable, if I have an insurance against that, so now the insurance, it can be converted into money, because now I have sort of guarantee to repayment. So part 1, we're gonna see on the next slide that the type of insurance where the insurer entity is the seller. And part 2, I will let you know during this display, that when the insurer is the lender. In other words, we place insurance into the seller business, and we also place insurance into the lender so he can pay for the goods for you to buy. So let's see how it works. And when it comes to a private insurance or any insurance, it works like an umbrella. It means that you're on top of it, like the one that it shows there, insure, and then you can provide to different buyers in different countries different terms and conditions. In this case, Uruguay 60 days, Peru 60 days, but you give them 80,000, and so forth. So we know we have options. Right now, I've been talking about insurance also, or only insurance. However, we have options for financing. So you can self-insure yourself. Let's say you have a lot of cash, a lot of money sitting in the bank, and they're earning only 5%. So you might as well use it. And you only need to buy the insurance. You don't need to get involved in any financing. Obviously, that's no cost because you already have it. It's not a high, it obviously is a low risk. I mean, and also it's limited capital, because that's the one, it's a high risk for you. However, if you use the insurance, you mitigate the risk. and your capital is limited because you have X amount of money. Now, there is another way, which is the factor. The factor means sometimes it's very expensive and requires low documents compared to a bank. And you don't have to have a high experience. So you can use the insurance and give it to a factor, and the factor will give you money against the account receivable and eventually will also pay to the provider. Another one is a letter of credit. Letter of credit, which is in Spanish. Sorry about that, but I'll fix that. Letter of credit or carta de crédito is a buyer's, depending on the buyer's cash flow. A little bit expensive and the control of the buyer. And the financing, which is a bank, a lender, is a low cost, the qualification and experience, and you also have the personal guarantee that you have to provide it. What I'm going to give you now is options that you don't have to go through that, something even better. So let's talk about the multi-buyer short term. Let's say about the insurance first. When it comes to insurance, I'll give you some example. Sometimes we do have buyers that you request, hey, I want to give to this Viewer Street Fishery, I want to give them $200,000. Sometimes we're going to give you the amount that you request. Sometimes we're going to give you partial. And even sometimes it's going to be a little bit different. In other occasion, we're going to refuse or cancel the transactions. Means that possible we couldn't find your buyer in our database. So at that moment, we're going to ask you to ask your buyer for financial statement. We never contact your buyer. We always ask you for you to give us the information. And on that, you're going to see that many of those in different countries, Brazil and Chile, you're going to have a different amount. We do get the credit reports from different countries, including Africa. And the quote that we're going to give you at the beginning, you don't have to buy the insurance until you get the financing. If you're looking for financing, means that the first step, if you give us the buyer small application and we get the buyers that you wanted to insure, once you're satisfied, we'll give you a quote. In this case, if you see the quote is for $4 million and all of them are in United States. That's about the lowest price that exists right now for private insurance. And that means that the cost is $12,000. And if you notice, this company, which is from Ecuador, a friend of mine, and we gave them a line of credit based on the maximum liability limit, $850,000. What is beauty about it is that this company never sold anything in the United States until he got the policy. And it costs $12,000 for now as a line of credit. Compared to a bank, the bank's going to ask you for a financial statement. In this case, we don't want to ask for that. Most of the time, we're going to ask for financial statement of the company outside United States, and we can see the experience of that company. This is another example. In this case, they were not domestic. They were all export, and it was a risk country. Because the country was for high risk, we have about $6 million on turnover, and he asked for $900,000. So the policy is almost $24,000, but everything is export, the double than the other one, because it's a higher risk. Sometimes what you do, you combine domestic and export, and they give you a blend. But that's to give you an idea. These are like the most expensive policy with a minimum amount of coverage. If you want to sell more than $6 million, $20, $30, $40, obviously it's going to be higher at the same rate, which is 0.39 cents in this case, if you notice right there. Now, the protection that we do when we write a policy is a bankruptcy, as I mentioned before, political, commercial risk, but also the slow payment from buyers or no payment means that you're going to give them a buyer 60 days for repayment. Day 61, you can start working on a claim. And then by day 90 or a little bit after, you get paid. And with the Export-Import Ban, which is the U.S. government, you have to wait 90 days. And after the 90 days, then you can place the claim in that case. And we help you on that. How does it work? A simple transaction. I just came back from Chile to do a seminar, so I use the Chile flag for now. A seller that has an insurance sells and do the risk mitigation with a Chilean company. We give the insurance. We endorse the insurance, and we make the bank to become a beneficiary of the insurance. Means that now the bank is going to give me the money against the invoice that I sold to Chilean. That's a simple transaction. What happened when I have an AR with a PO financing? It will work this way. PO means purchase order financing. I have a company in US, and then I obtain an insurance. And for that insurance, I endorse it to the bank. The bank is going to pay the distributor, and the distributor is going to send me the goods so I can send it to someone in Chile, or I can send it somewhere in the world. So that's as simple as that. That's the cash flow, the whole business that I control now. Now, what are some different that is important to mention owning your own insurance? You have to tell you this, that you can get a factoring, you can get from the bank, but if you don't pay, they go after you, they go after the company. And most of them, they're going to ask for personal guarantee. That means that they're going to go after your home or after your car. So in this case, we negotiate with a validity guarantee. Why someone's going to give you a validity guarantee and they don't want to give you if you don't own your own insurance? Look at this way. Let's see if you can catch me. If I don't have insurance, I have to collect it. But let's say, remember that I said that we also do insurance to the lenders. Let's say I'm a lender and I have a master policy insurance. I'm going to offer you a loan, but I own the policy. If I have 3 buyers and they're all selling, and one of them have to put a claim, the premium is going to increase in my whole policy. When you put a claim and you had an accident in the car, what happened next year? The insurance is more expensive, right? Or when you have a home and you have a hurricane, the insurance is more expensive the next year. Same thing happened when one of the client of the lender put a claim, the insurance is going to be more expensive for the lender. But what's happened is all the buyers that they have under that policy, because master policy is going to increase the price. So what happened? Many of these lenders, they don't want to put the claim because it's going to create expense in their company. So they be very careful. I'll give you an example. I have a company that sells mobile cell phone, and that nobody likes that industry. If that company goes to one of these companies, the lenders, they're going to say no. But if this company comes with their own insurance, they're going to say yes. Because if tomorrow the insurance, they don't pay, it's going to be the claim of this individual client. It will not affect the lender because the policy is owned by the seller. So that's the reason you get a validity guarantee with that lender, because it had nothing to do with that, right? So that's something huge value on that. Validity guarantee means that you're not guaranteed as a person, and most of the times you're not guaranteed as a company. So the lender goes direct to the insurance. Now, the next benefit is the real buyer's coverage. Many times you have a buyer and they want $500,000, like the one that you saw, $300,000. A lender could decide, listen, I don't want to give you $500,000. It's like too much to start. But how do you know it was a lender opinion or was the insurance approval? When you own your own insurance, you know what you control it. Now, claim control. When there is a claim involved, you do all the effort. If the lender can collect the money from another account receivable, it will, so it can keep going. Also, your insurance, you can move the insurance to different lenders if you want it. And also another benefit that you don't get, unless if you own your policy, we keep monitoring your buyers and we're letting you know, stop selling to this one, stop selling to that one. Like Kmart, when they closed 1,000 600 stores. We knew that before they start closing those. We were no insurance Kmart. So the deductible, you can choose a deductible, lower cost for third parties. I mean, you can buy on a better way, growth based and what you can sell. This is another one which is huge. Your growth is based on what you can sell, not who you are. The worst thing that a business wants is that that they're gonna give you money based on your net worth, based on your experience, based on so many if. But if you can sell, I can give you the money against that. That's the best. That's something which is huge. And also you can do it worldwide, and many times you don't need experience to start with your own insurance and go with a lender. So any questions so far? But that will be for the live session, right? Good. So let's talk about United States government now. The Expo Import Bank was in 1934 funded. Now it's about 90 years. It's a supplement credit. So that means that what we're looking for here is for export goods and services made in the United States. And the whole goal is to create jobs in the United States and compete with the export with other countries. So it means that the product must leave from the United States. So, and it calls this type of agency called ECA, Export Credit Agencies. Those are the name. You can Google it. This is some of the billions of dollars that the US government provided the authorization during the years. So 2023 is the most recent. We're growing. After the pandemic, we got a hit like anything else, but now we're moving ahead. We're moving with the 2023 with almost $9 billion. After 2012, that we're doing like $35 billion. So we're moving on a good direction. Now, in the short term with the Exim Bank, now we're talking about the government carrier, which is the US government. Now, the exporter is the one we're going to be insuring. Our beneficiary is the bank. We're going to endorse it. It must be 51% US made, and we're going to insure 95% of the invoice. There is a policy which is named Express, and Express has very special. It's only for a small business that they have no experience or very low experience. Keep in mind that X-Man requires for you to be 3 years in the business, no exporting necessarily, but be in the business. And so Exim will give you under this policy, the content doesn't have to be by itself 51%. So you can have an invoice that the product A is 51% and product B is 49%. If you put in one invoice, we're going to insure the whole invoice. And other policy, the content must be included. It will be has to be one product. That product must be 51% US made. Another good thing that this policy has is that you can include the expenses of your company, like the accounting, like the marketing, and that will be another explanation, which we can go in detail when you contact me. These are some examples and some of my clients that they approved $20,000, $50,000. These are short term, $100,000, $200,000. And the cost, the one you're going to see most of the time that most of the use is what it says 1 to 60 days, means 65 cents. For $100,000, it's going to cost you $650. Again, sorry that it's in Spanish. I just came back from Chile. I took my Chile presentation. I just digested. I'm going to do some fixing now. So tomorrow is going to be okay. So really for $100,000, you're going to pay $650. And in this policy, you pay as it goes. So if you don't use it, nothing happened. You do going to pay the government $500 deposit when you start, and that deposit going to give it back to you if you don't use the policy. So the importer application normally is nothing. We're going to ask you for documents. We don't contact the importer. You're the one who is in control. We want it to be in the same line of business and no negative information. Normally, I like to show the website of the government. If you notice there is exim.gov, it's because what I'm going to explain you now on the next slide is exactly from the website. And this is what it is. For buyers that you have, imagine that you have, remember that I show you like the umbrella. You're on top, you're the seller, and you have three buyers at the bottom that you're selling. Now imagine that you have three buyers. One of the buyers asks for $50,000 for you to provide credit. If the buyer doesn't pay you, the government will pay you 95%. The product must be made 51% US made. So the only thing we're going to ask you is going to be one of these four items. Notice that it says credit report, trade reference, ledger experience, or financial statement. And credit report under multi-buyer policy express, the one that I mentioned to you, that's something else good. When you're a new one, or you're not new one, I'm sorry, because you require 3 years in business. But when you are very small experience on giving credit to export, the government, you want to be qualified on the express insurance. Under express insurance, you get free credit report from U.S. government. So in reality, if you have a $50,000 buyer, you just give me the information on the buyer. But keep in mind, you're going to give me as much information as you can because we need to find the buyer. Address, telephone, website, company number, RUC, or whatever number they use in that country. If you have the registration of the company in that country, whatever you have, so we can find the right company. And here it says that if I give you the credit report free, if it's available, really, you don't have to give me anything from the buyer. It's amazing. But when you go to $100,000 to $500,000, now credit report you must have. And in addition, you're going to give me one of the following: trade reference, ledger experience, and financial statement. And ledger experience means that you get an Excel sheet and we give you a format, which is, it says the invoice number, the date that you ship, the date that you got paid, the amount you got paid. It's like a history, basically. That's what it is. So when it goes to up to $1 million, now you need more documents. So in this case, you need the credit report, and then you need the other one, the trade reference, or the ledger, trade reference or ledger. And then at this moment, you must have a financial statement. And it have certain guidelines that I don't want to go over because I want to make this short. And when you go up to $10 million, it's the same thing, but you have certain criteria or parameter that must meet, so we can provide you with the approval of that buyer. So this is the end of part one, which is where the sellers is insured. Let's look at the second part. Now we're going to insure the lender. Under the lender insurer, we have two options. What does that mean when the lender is insured? Your buyer is in Colombia and he wants to buy in United States rice, and he wants to buy us 180 days term. So the buyer doesn't get the insurance. You are the seller, but I'm going to insure the bank. So now the bank is going to pay you, and you're going to let go the merchandise. Same thing happened with the medium term. It means that we're going to give you the 85% of the value of the goods, and then you're going to let go the goods, and the buyer is going to pay you 15%. Those are 4 transactions that they're 3 years, 5 years, 7 years. We financed recently trucks in Mexico. There was $1 million. So we pay $850,000 to the supplier, and $150,000 came from the buyer, and then the merchandise left to Mexico. And so that's a way that we do it with the lender. So the product must be export from US, and we're going to help you to the transaction. This is only to give you an idea. This is a trade credit reference. That's not the way we want it. This is the way we want it. We help you out. This is one correct trade reference. We also want to get credit reports These another credit reports when I help you to obtain. So we'll take you by the hand to make that happen. So they might come up with a few questions. I don't want to make this long because gave me only about 45 minutes. So let's talk about the medium term now. Medium term, we have exposure fee, which could be as an insurance or as guarantee. Each country has different risks. So let's say Brazil's 3.67, if we give to the government, but it's from 3.31 to 8.52, depending on the quality of the package that we're presenting that is going to be involved the cost of the insurance. So it depends on the country. When it comes to the moments that you have somebody that wants to apply, they send us the financial statement, we review it for free, and we give them a letter of interest, and then they're going to have the exactly the amount that they're going to get on the interest rate, down payment, and all the costs that are involved in the transaction. So the exposure fee, it will look like that. Let's say Chile is at 2%, it's a low risk country, it will look like that. And we can also finance 30% of the local costs, let's say to build something. And the medium term, it can be done according to the amount. We go with the years. And also, let's say we give you $1 million, that $1 million could be that you choose to get $500,000 immediately, and the other $500,000 you might want to get it in 2 months. You let us know how you're going to use it. Could be one shipping or multiple shipping. And when it comes to nuclear plants, we can go 15 years, airplanes 70 seats or more up to 12 years. And some of the benefits is that payments every 6 months. We have a grace period up to 2 years. The rate could be fixed or adjustable. I mean, we'll provide it to you in the term sheet. And there's no deductible on this policy as the other ones. And most of the time, the products are guaranteed. So they said, give an example, if we're going to finance cable, we might ask for another type of guarantee instead of the cable, because we cannot pull out the cable once it's installed in the company. So, but a truck will be the guarantee. The risk can be transferred, so it means that if you have a project or you have something to build, you might don't want to use the new company, because that would not be the applicant, because they would not qualify, and in 3-year financial statement. So the parent company could be the one who's going to be the guarantee for the transaction. And you can use it gradually. And you can also get the 15%, because we finance 85%, you can use the 15%, can come from a third source that you can get your 100% finance if you want. In this case, remember the lender is insured, and used equipment is okay. As a matter of fact, the one we did in Mexico, there were used equipment. Usually shipping documents, it will be only the invoice, bill of lading, and the export certification. This is after everything is approved and we get it done. So at this moment, we only have one thing left, which is going to go very quick, the short term and also the project finance. We're going to try to make it quicker. Short terms is going to work like a purchase order financing. This program calls FIBC, Financial Institution Buyer Credit. This means that right now we have a transaction that they're buying rice. They're having, also another one that they're buying supermarket goods. So we're going to give them $900,000, $1 million. So those buyers in Colombia and also in Dominican Republic, they're going to buy goods from US. So we're going to qualify the buyer, and then we're going to insure the bank. Once the bank is insured, the bank will pay the supplier, and the supplier will send the goods. Basically, it's kind of a purchase order financing. Normally it's 180 days. We can go up to 360 days. There's no deductible. It's a revolving line of credit. The medium term before is a line of credit, but it's not revolving. Sorry, it said resolving, but it's revolving. Pay what you use. The insurance is that we cover 90%, and the lender must take a 10% risk, but you get 100% of the goods. Some of the benefits, easy to compete. You don't have to keep inventory. It's a low cost. I mean, you can use it as many times you want, so it can be renewed every year, and that give you a capacity to grow. And direct payment, there is no middle bank, obviously, no letter of credit involved, and any of these type of financing. I'm telling you, there is no letter of credit. Like I said, less inventory. So finally, project. We don't want to go long on this. Project, you only want to show you this structuring of a project. The contract, it must have a contract on each part. And basically, that's it. So if you have any question, you can write me. You can send me your financial statement. I'll be happy to take care of it, and look forward to see you tomorrow at the event. Take care. Thank you.